Today we're going to be working on notes. So let's start off with what is a note? A note is essentially a loan. And how we're going to be working on it today, it's basically an interest-only loan. So someone is going to go ahead and lend us money, or we're going to lend someone else money. And then what we're going to do is over a period of time, we'll either make interest payments as we go, or if it's a short note, we may just go ahead and pay all of the interest at the end of the period. So let's go ahead and take a look at something that we may see for a note. Again, the ones that we're going to be working on are relatively short term. So we're going to say that we borrowed $10,000 on a 60-day 5% note. Okay, it's going to be important for us to understand a few of the things going on here. First being, how long is the note for? So we know our note is going to be for 60 days. The second, what is the percentage rate? Now this is a part that might get a little bit tricky. We see that percentage rate and we assume it's going to be the percentage rate we use for the entire thing. Except the way it works is this is actually going to be our annual percentage rate. Which means that's the amount of interest we would have to pay if we borrowed that for the entire year. Okay, so we've got the 60-day here. This is going to be called our term. How long are we borrowing it for? And this amount up here, this $10,000, this is the principal amount. Okay, let's go ahead and start working. Now there's a few tricks when we work in accounting. The first, when we're working on something like this, we're only going to use a 360-day year. You may say to me, but we got 365 days in the year, except for that whole leap year thing. Correct, we do, right? But for this to just make it a little bit easier, we're going to assume it's 360. Why 360? It breaks out into 12 even periods. So getting back to our note here, how are we going to figure this out? Well, let's go ahead and start by finding out what the interest would be if we had to pay it for the whole year. So we're going to take our principal. Which is our $10,000. And then what we're going to do is we're going to multiply it by our interest rate. In this case, for the notes, I'm just going to shorten it to rate, which was 5%. All right, 5% of $10,000, $500. Now again, I'm going to put a note next to this because this is going to be our annual interest rate. Now that we found out the interest for the year, we're going to go ahead and find out what would it be for our period. So to figure out our period, we're going to take that $500 and we're going to multiply it by 60 over 360. We end up with $83.33. Now granted, this goes on forever, but we only work in pennies, so we're going to stop there at the 3 cents. Now we know what the interest amount is. So let's say we asked to go ahead and record the entry for this at the time that, again, we borrowed this, right? So we're going to go ahead and recognize this at the time we borrowed it. What came in? Someone gave us cash. That's going to be my debit of $10,000. What are we going to have here? Well, we said it was a note, so we're going to have to keep this as a notes payable, not an accounts payable. We've got a notes payable. of $10,000. All right, that's on the date of issuance. Next, we're going to have our date of payment. And this is when we're going to go ahead, we're going to pay back that $10,000 that we borrowed and any interest that we had accrued over that period of time. So now we're going to go ahead and get rid of that notes payable. It means we're going to debit our liability. For that $10,000. But whoever lent us this money is expecting to get back more than $10,000. They're expecting to get back that $10,000 plus our $83.33. So we know when our cash is going out, I'm going to skip right down to the bottom and put my cash going out. It's going to be $10,083.33. Number one rule in journal entries, we need to make these equal. So what does this represent? In essence, it represents the cost, the current period cost of us borrowing this money. It means it's going to be an expense. Specifically, this was for interest. So this is going to be our interest expense. And it's for those $83.33. So let's go ahead and talk about some words we may hear about our loans. I'm going to erase part of this over here, specifically the journal entries. So the first term we may hear is principal, and that's the amount that we actually borrowed or that we lent. On this one, it's going to be the $10,000. We may ask for the interest rate. The rate will always be expressed in annual interest terms. So in this one, it was just our 5%. May also ask for the interest payment. In this case, it's that $83.33. Another one that we may find is being asked for what the maturity value is. The maturity value is what we're going to have to pay when we reach the end of our term. The initial $10,000 that we borrowed plus the $83.33 that we accrued in interest. What we might also be asked on this is what is the term of the loan? The term is telling us how long it is for. And for this one, it was 60 days. All right, and that's how we're going to go ahead and work with notes in accounting. See you again soon.